Move in with your partner for 12 continuous months and the CRA quietly reclassifies you as one household. No wedding, no paperwork from you required. That single switch can cost or gain a couple thousands of dollars in benefits, because programs get recalculated on your combined income. I read the fine print so you don't have to. Here's exactly how that switch works and where the money leaks out. Here's the simple version. Common law, for tax purposes, is a status the CRA assigns you, not something you sign up for. The CRA says it begins after 12 continuous months of living together, or immediately if you share a child. Think of it like two separate bank accounts the CRA suddenly staples together. From that point, it judges you on the combined total. And that combined view is exactly where things get complicated. So here's how it actually works. Part 1. Credits like the GST/HST credit and the Canada Child Benefit are tested on adjusted family net income, meaning the CRA adds your partner's income to yours. Think of it like a shared bathtub. The CRA fills it with both incomes, and once the water hits a certain line, the benefit drains away. A payment you comfortably qualified for alone can shrink or vanish once two incomes share the tub. Part 2 is a credit most couples don't realize is there, the spouse or common law partner amount. In 2026, your partner's net income has to sit below your basic personal amount to claim it, or below that amount plus $2,687 in the caregiver case, per the CRA. Think of it like a height limit at a ride. A small bump in your partner's income can put them just over the line and knock out the entire claim. It's worth a few $1,000s in relief, so the threshold matters. Part 3 is the deadline nobody hears about. The CRA requires you to report a marital status change by the end of the following month after it happens. Think of it like a change of address card. The CRA won't update anything until you actually file it, even though your status technically changed on its own at the 12-month mark. The clock starts automatically. The paperwork is your job. A common misunderstanding, Part 4. Becoming common law does not mean you file one joint return. In Canada, each person still files their own. Think of it like two students writing separate exams, but the teacher now grades you on a shared curve. Your incomes stay on separate returns, yet the CRA links the files behind the scenes to test your household benefits together. Before I get to the most counterintuitive piece, the part that can cost you across multiple years, here's the catch the brochure skips. Here's the catch. If you don't report the change on time, the CRA can go back, recalculate your GST or HST credit and child benefit on combined income and ask for repayments. Think of it like an overpaid paycheck. It feels like free money until payroll notices, then they want every dollar back. Payments you already spent can quietly become a debt you owe. If this is useful, subscribe. The next breakdown is already coming. And this is the part most people never see coming. The CRA can reassess prior years, so not just the current one, for any period you were common law but filed as single. Think of it like a library fine that keeps accruing quietly. The longer you leave it, the further back the reachback goes. That's why a status you never formally updated can turn into several years of recalculated benefits all at once. So here's what this means for you, practically. Sign in to CRA My Account, open your profile, edit your marital status, and confirm the date the change happened. Think of it like updating your emergency contact routine. 30 seconds now saves an enormous mess later. Getting it recorded by the end of the following month is the difference between a clean file and a future clawback letter. Once your status is updated, recheck every benefit. Compare your combined family income against the GST, HST, and child benefit cutoffs on the CRA's own pages, and note whether each payment is reduced, stopped, or unchanged. Think of it like rereading a contract after renewal. The numbers moved, so your terms did too. Then look at whether you can claim the spouse or common law partner amount, because sometimes the new status opens a credit instead of closing one. Moving in together is a tax event most couples find out about only when the clawback letter arrives. Now you know the 12-month rule and how to stay ahead of it. Next, I'm breaking down exactly how the Canada Child Benefit clawback is calculated, income band by income band. If you want to catch that one, subscribe so you don't miss it.